Bitcoin is about to enter its most violent acceleration yet. Not because of hype, not because of retail FOMO, because the macro machine has reached a point where there's no way out except through. The world is running 400% of GDP in debt. Governments can't pay the interest bill with growth. Central banks can't keep tightening without breaking the system. When the debt is that large, you either default or debase. And history shows policymakers choose debasement, always. That means more liquidity. And when liquidity rises, the assets that actually outrun debasement don't grind higher, they go vertical. Today, we'll break down Raoul Pal's framework for why this cycle is 2017 on steroids, and why only two assets truly matter in this regime. But before we dive in, if you want to stay ahead of the curve, I break it down every day in the Crypto Nutshell. It's my free 5-minute daily crypto newsletter, built for investors who want quick, actionable insights without the noise. Check the first link in the description, drop your email, and you're in. All right, let's get back to the video. There's one truth no politician, no central banker, and no corporate board can escape. The math just doesn't work anymore. The global system is drowning under the weight of compounding debt. Every year, the interest bill grows larger than the economic growth that's supposed to cover it. That gap isn't closing, it's widening. And once the interest burden passes a certain threshold, the game is over. The US isn't suddenly going to deliver 6% GDP growth for a decade. Europe isn't about to double productivity. Japan isn't reversing demographics. The math doesn't allow it. That leaves policymakers with two options: default, write down savings, pensions, and assets overnight, or debase, inflate it away slowly, using liquidity to paper over the shortfall. Raoul argues this isn't even a debate anymore. Debasing is the only real option.
Lynn Alden's statement of nothing stops this train becomes true every day, because the US government paid lip service, or at least tried to do something, at least pretend to look into doing something about debt growth. Yeah. And even Elon, who can solve going to Mars, can't fucking solve this. So It's like game over. I mean, that is never going to get solved. So this cycle is going to continue, and it has to continue. And the issue is right now is interest payments are at this level and GDP growth is still at this level. So there's not enough GDP growth to pay the interest payments. So the interest payments keep compounding, which is the thing that everybody picked up like Elon did, which is why Scott Bessent, everybody's screaming to get rates lower.
That's the bind. The system can't survive higher rates. The interest bill alone is a monster. And because politicians won't cut spending, the only lever left is liquidity. Since 2008, that's created a new metronome, a 4-year cycle where governments refinance, central banks ease, and liquidity ramps. Over time, that liquidity never gets fully taken back. It keeps ratcheting higher, compounding at roughly 8% a year. That 8% debasement rate is the real inflation nobody talks about. It's the hidden tax of fiat. And once you see it, you can't unsee it. So the obvious question becomes, if everything is being debased, what actually keeps you ahead? For decades, the answer was diversify. Own a little bit of everything: stocks, bonds, gold, real estate, and you'd survive the storms. But in a one-factor world where liquidity drives all boats, that playbook doesn't create wealth anymore. It just leaves you treading water. Raoul tested it by dividing every major market by global liquidity. The results were brutal. Equities, which look strong in nominal terms, flatten out once you adjust for debasement. Gold, the classic inflation hedge, holds steady but doesn't compound. It preserves, but it doesn't grow. Real estate looks powerful on paper, but strip out liquidity and it's essentially a flat line. Almost every asset, once adjusted for the hidden 8% debasement rate, stops creating wealth, except for two.
But over time, liquidity keeps rising. It's rising at a rate of about 8% a year. And that is, in fact, the debasement rate of fiat currency. And what happens is, and this is the bit that gets contentious with people and they hate it, if you divide an asset by the global liquidity, you get to see whether it's outperformed. The debasement.
People hate that chart.
Oh, they hate it. But it is the best chart in the world because it then tells you, okay, if I'm to allocate to the S&P 500, I'm basically breaking even versus debasement. So the S&P 500 is not really adding much value. Well, when you look at the Euro stocks and other markets, which are priced in their local currencies, you put them in dollars, they look similar. They all the markets look very similar once you adjust for debasement. So that was interesting to me. Gold, complete almost flat line, really, versus debasement, as it should be, right? That's gold's job, it's to be the stable currency. And once we use looked at the world through this lens of the debasement of fiat currency, which again is still contentious, becoming less so nowadays, but it was really contentious when we started it, we realized there's actually only two assets that outperform this. One is tech stocks and the other is crypto. And so that completely changed how I allocated and how I understood tech stocks.
Think about the implications. Hold the S&P and you're breaking even. Hold bonds and you're falling behind. Hold gold and you're flat. But hold tech or crypto and you're compounding actual purchasing power. That's why Raoul argues this cycle is fundamentally different, because now it's no longer a secret. Everyone, from retail to institutions, recognizes that crypto sits in the same category as tech. The difference, tech is about innovation. Crypto is monetary innovation. It's the purest expression of liquidity expansion. And when liquidity is the only factor that matters, the assets leveraged to it don't just outperform, they accelerate. This is the part traditional investors hate to hear. The models they've built their careers on, discounted cash flows, value screens, sector rotations, none of them work in this regime. Why? Because all of those models assume markets are driven by a web of independent variables: growth, profits, rates, politics. But today, it all collapses down to one factor: liquidity. Raoul's research shows that almost the entire market can be explained by it. 97% of the stock market's price action is liquidity driven. For crypto, it's 90%. That means every other variable, earnings, valuations, inflation headlines, even geopolitics, accounts for less than 10% of the move.
97% of all of NASDAQ's price action is driven by debasement. It's the strongest factor we've ever had in any macro regime in history. Okay, great. That makes macro super easy. For crypto, it's 90%. So we've basically got a factor that's so powerful that nothing else matters. Brilliant. So then let's take the NASDAQ. If we've got one force, one economic force, we take the NASDAQ, we divide it by Bitcoin, it's down 99.97%. So you kind of get one asset allocation only, which is crypto, which is bizarre. In a macro world, we now think you need concentrated portfolios as opposed to diverse portfolios. In fact, diversification just destroys returns now because you've got one clear macro factor.
In other words, diversification isn't safety anymore, it's dilution. If liquidity is the tide that lifts or sinks every boat, scattering your bets across asset classes just guarantees you underperform. And here's the second punch: concentration isn't reckless anymore, it's rational. If one factor drives nearly the entire outcome, the winning strategy is to concentrate in the boats that rise fastest when the tide comes in. That's why Bitcoin and crypto are positioned for acceleration. They're not just correlated with liquidity, they're a high beta expression of it. When liquidity expands, tech climbs. But crypto doesn't just climb, it surges vertically. Traditional investors don't want to admit it because it means decades of portfolio theory collapse into a single line. But the reality is clear. In this regime, there's one macro factor to rule them all, and Bitcoin is its purest expression. So where are we in the cycle right now? Raoul and Julian map today to 2017. Back then, the dollar spiked into Q4, then rolled over. Liquidity rose, financial conditions eased, and crypto detonated. Bitcoin ripped a 23x move from its January lows to its December peak. It was the first true mania phase for digital assets, and it rewired how investors thought about cycles. Fast forward to today, and the charts look eerily similar. The dollar surged, then softened. Global liquidity is rolling higher. The ISM has been scraping along the bottom. It's the same setup, but Raoul argues it isn't just a repeat. It's 2017 on steroids.
Here's something interesting, because 2017 was a big cycle for assets, as we know.
Yeah.
Does this speed of M2 make a difference or not? The question within the plumbing is what actually moves the dial in terms of the ultimate debasement, because this is a super accelerated easing of financial conditions going on that's driving M2 and driving the dollar. I don't know whether that's going to make it more powerful, different. I mean, it's hard to be more powerful than 2017, but that was early adoption phase in crypto. But tech did well. I don't know, but it just seems to be 2017 on steroids.
I sort of feel like it is, yeah. I don't think people want to admit this yet, but it does feel more powerful in so many ways.
What makes it so much more powerful this time? Broader liquidity channels. In 2017, the flow came mainly through central banks. Now, liquidity is surging not only through them, but also through private banks, shadow banking systems, and soon even stablecoins as conduits for capital. Institutional adoption rails, ETFs, Fidelity Custody, Schwab Access, retirement accounts, gateways that didn't exist last cycle. Today, trillions in retirement and corporate capital can access Bitcoin with a single click. A suppressed core economy. The business cycle has been pinned down longer than ever. When it rebounds, the snapback extends risk appetite far further than in 2017, and the adoption mix has shifted. In 2017, demand came from retail and crypto natives. In 2025, it's retail plus institutions plus corporate treasuries. The pipes are bigger, the pools are deeper, and the accelerant is stronger. Which means if 2017 produced a 23x, this cycle carries the structure for something even larger. Every parabola needs a trigger, and in crypto, that trigger has always been the same. Liquidity conditions ease, the ISM rises, and capital rushes out the risk curve. Raoul and Julian break it down as a sequence. First the dollar eases, then financial conditions loosen, then global M2 climbs, then risk assets run, which leads to the ISM improving, and then finally capital rotates into higher beta plays like altcoins. That chain reaction is what Raoul calls the banana zone. Back in 2017, once the ISM pushed decisively above 50, Bitcoin ignited and altcoins went vertical. The same mechanics played out in 2013 and again in 2020. The signal hasn't changed. And today, the ISM has been pinned down for longer than ever, which means when it snaps back above 50 and trends toward the mid-50s, the setup is even more powerful. That's the historical sweet spot for alts to catch fire.
Once the ISM gets above 50, right, and then moves into its sort of late cycle peak, call it anywhere around 60, this tends to be where we get these really big moves in risk assets, and crypto included. It's also where we see alt season happen, right? Which is really what people are saying win banana. And the win banana, we're up 600%. I mean, the banana zone is not a 1 month get rich thing, right? It's, Bitcoin's up 600% since we set a low in Q4 of 2022. That's, been a steady banana zone, but the question then is, when is the next leg? Well, we'll get the next leg as the ISM progresses towards 55, because the thing to think about this is just like a credit spread, right? It's just like small cap versus large cap equities, which once you get into Bitcoin, which ETFs will be the large onboarding there, you got to think about that as like the way I think about that is like the gateway drug to crypto. So even if you're making good money in Bitcoin, all of a sudden, if you're already orange pilled, right, and you're seeing something going up like Pepe or Bonk or Sui or Solana or whatever it is, you start to recycle those tokens very similar, like you'd be taking profit from a large cap growth equity at the bottom of the cycle and recycling it into small cap value and EM equities. Does that make sense?
Yeah,
and so
totally.
The economy's in a very different place, and the forward setup in terms of financial conditions looks good, but then also liquidity is rising. Okay, so here again, total liquidity, the 6 month flow is actually broken out of this kind of the range that we've been in. And that range that we've been in explains a lot of what has basically driven these knee-jerk reactions in crypto. The trend has been higher, but there's been, periods of time like the first half of last year, or even, the first quarter of this year, where basically we were just, kind of stuck in a range, which feels like that again now, but it's not the case, I don't believe. But so we still think here's as we call it, the most copied chart in the world when it comes to Bitcoin. But I still think that the point with this, and Raoul and I have said this repeatedly, even though, you've got people on Twitter who are monitoring this tick for tick, it's not about that. It's about the direction of travel and the fact that the trend rate is still growing. And when you then look at the year-on-year comps, it's just kind of another way of thinking about this or looking at this. And I think that this very much paints the forward setup. So yeah, when you compare, as I said, the 2021 cycle versus the situation that we're in now, and we've both said that liquidity and the business cycle are the two most important drivers, risk assets, and that also applies, to Bitcoin and the entire crypto universe. These two elements are going to head higher over the next, let's say, 12 months, whatever. Into Q2 of next year.
The key point, nothing stops this train. Not because policymakers want it, but because the system itself demands it. When debt loads are this high and growth can't cover the interest, liquidity expansion isn't a choice. It's the only option. 3 key differences elevate this run beyond anything we've seen before. Permanent liquidity architecture. Liquidity isn't just central bank QE anymore. It's fiscal deficits, private bank balance sheets, and soon stablecoins absorbing supply. The pipes are bigger, and they're permanent. Adoption rails. In 2017, you needed Coinbase accounts and cold wallets. In 2025, you click a button inside Fidelity or Schwab. ETFs make Bitcoin a default allocation, not a fringe speculation. Macro patience. The core economy has been stuck below potential for longer than usual. When it finally lifts, the extension of the business cycle could stretch this rally further than most expect. And the sequence that drives it all is simple. First, financial conditions loosen. Then, global M2 rises. Markets recover. And finally, the ISM confirms the upswing. That's the roadmap. Here's the final takeaway. Parabolas don't announce themselves. The structure builds quietly, then the chart goes vertical. If you wait for the parabola to be obvious, you've already missed it. That's why preparation now matters more than prediction later. Decide your allocation bands. Decide how much you'll hold through volatility. Set your profit-taking rules before the mania begins. Because once the parabola arrives, the hardest thing in the world is to act rationally. Greed convinces you to hold forever. Fear convinces you to sell too soon. Only preparation keeps you sane when acceleration hits. Raoul's message is blunt. In a one-factor regime, liquidity dictates everything. Tech and crypto gain purchasing power. Everything else just fights to stand still. And if liquidity continues trending higher into next year, Bitcoin won't just rise, it will super accelerate, faster, harder, and further than most think possible. So if you found this breakdown useful, hit that subscribe button right now. It helps the channel grow, and it makes sure you don't miss the signals that matter before the parabola begins. See you all in the next one.